Good morning, everybody, and welcome to today's webinar on construction insurance. Today's webinar will be presented by special guests Bev Bracey and Steve Cox. A special thank you to Steve, who's joined us at such a short time last night. Unfortunately, John, who was supposed to attend, has got a family emergency. So thank you, Steve, for joining us at such short notice. So Bev and Steve are both from Willis Towers Watson, one of the insurance brokers on our insurance brokerage framework. So before we get started, I'd just like to do a couple of introductions. So I'm Sarah Jarvis, for those that haven't joined any other of our webinars that we've done, and I'm a category buyer here at YPO in Corporate and Financial Services. Two of the frameworks that I manage is the Insurance Brokerage Framework and the Insurance Placement DPS. So we've got Bev Bracey, who's the Executive Director Government Sector Practice. So Bev has over 30 years experience and joined Willis in 1986 after 3 years with a large insurer. Bev has been providing an insurance due diligence and insurance support service role to governmental and public sector clients since the early 1990s, initially providing services to the NHS, and in more recent years she has worked on a large number of governmental and public sector projects, insurance placements for central, devolved and local government entities. Steve Cox is the Deputy Practice Leader and Executive Director. So Steve has been working in the construction insurance market since 1981 and with Willis Towers Watson for the past 16 years. Steve represents both principals and contractors and has a broad knowledge of the needs for all parties to a construction project. So before I pass over to Bev and Steve, I'd just like to go over a few items so you know how to participate in today's event. You have all joined the webinar in listening mode only, but we would really like you to get involved where you can by asking questions by using the button at the bottom of the screen to answer questions throughout the webinar. Steve and Bev will answer these questions if they can throughout the webinar, or if not, we'll come back to them at the end. And any questions that we are unable to answer during this webinar, we will get back to you after the webinar is finished. So now I'm going to pass over to Bev and Steve.
Thanks very much, Sarah. Could you go to the next slide, please? Right, that's who we are and our contact details. And as Sarah said, we're happy to take questions as we go, although obviously we'll leave any tricky ones to the end and avoid them till we can have some time to think. We'll also do it like that. I'm based in London normally. I'm working from home, have been since March, and Bev is based in our Bristol office. Go to the next slide, please. I'm going to talk about the insurance classes that we deal with in the UK construction insurance market, and then I'll explain a bit about what's happening in the market right now with insurers looking to charge more premiums, higher excesses, and they're limiting the coverage that's available to be bought. We refer to this particular time in the market as a hardening market, and I can tell you that the market was softening with terms getting cheaper and cheaper and coverage becoming broader and broader for more than 20 years prior to this event of hardening. I will also touch on professional indemnity, although I don't claim that as a speciality. Obviously, I do become involved in professional indemnity. At Willis Towers Watson, we have a team called Finex, which specialises in both the professional indemnity and directors and officers, pension trustees and the like professional classes. I will go on to explain what buyers can do to obtain the best terms in these hard times. And then I'll pass on to Bev to talk through the insurance provisions in contracts. As we've already said, I'm happy to be interrupted as I go. Much rather these events are interactive. So please submit any questions as you think of them. And if technology allows, I'll handle them as we go. As I say, tricky ones at the end. Can we go to the next slide, please? So the key classes that I work with are contract works, all risks. We put the all risks in inverted commas there, and I'll explain a bit more about that. This applies to new buildings, extensions of buildings, or refurbishments, fitting out of buildings. And I think the best way to explain it is just literally to read out what we would categorise as the insuring clause within our policy wordings. And that says that it's there to cover all risks of loss, destruction or damage to the insured property or the works during the period of construction from any cause not hereinafter excluded whilst within the territorial limits. So it's a really nice, short but very broad description of what's being covered within a contract works all risks policy. As I said, we put all risks within those speech marks, and that's basically because it's a bit of a fib. There are exclusions within a policy, so whilst it's covering all risks, as they said in the insurance clause, it's as long as they're not hereinafter excluded. So beware that is a bit of a fib. There are things like inventory losses, wear and tear, electronic data, cyber type exposures that are not covered by that works insurance. Next one, vitally important, is third-party liability. That includes products liability associated with building products. And this covers the insured's legal liability for death of or injury to third parties and damage to third-party property arising out of the works or consequent upon the event of doing the works. Next one, non-negligent indemnity or liability of employer. It's had many names in its life. Interestingly enough, it was actually created by a lawsuit in the year I was born. So it's a very ancient and old insurance policy that's come into being. But as you can see there, it's in the JCT form, currently known as liability of employer, but it has been known as varying titles from JCT 192A, 2121 or 651. It is quite confusing insofar as it's giving cover where a negligent event hasn't caused damage to occur to third-party property. The coverage within that, the insurance policy, states that it's for things like vibration, removal or weakening of support and lowering of groundwater. So those triggers causing sort of possible cracking or damage to third-party property is what this insurance is aimed at. Probably the last thing to say on that particular cover is it's vitally important that it's placed with the same insurers that are writing the third-party liability. By doing that, you remove the ability for two different insurers, if they were involved, being able to create an argument around whether it was negligent damage or non-negligent damage. Next one down the list is something we've come to know as DSU, delay in startup, although I prefer often the delay in completion or advanced loss of profits headings. And this is intended to protect the financial consequences of a project being delayed due to an event that occurs during the build period and that's insured by the contract works policy. It can cover sort of increased costs associated with having to rent alternative premises, the loss of profit arising out of what the building might have been being used for once completed, and the like. This is only available where the contract works is being purchased at the same time, because the contract works insurers who are insuring this DSU cover feel that they need to have the ability to speed up any rebuilding work by an economic loss provision to avoid the full payment of a DSU. So where they can do that and it makes financial sense, they will always speed up the rebuilding work so as to avoid paying out significant numbers under this particular heading. Terrorism, probably better known as terrorism buyback. This came into being in probably the late 80s, early 90s, where particularly the IRA bombings around the UK against property had led insurers to saying, why are we paying for repairs to all of these properties when it's a sort of government thing that's put us here? And that kind of forced the government to create a pool, and that pool exists to this day. It's called the Pool Reinsurance Company, and it is there to cover material damage losses associated with the likes of the contract works or property, or even this delay in startup cover that I was just talking about. It's actually paid very few claims since it was created, and is a bit of a slush fund. I think you may have seen it mentioned earlier this year as a source of potential funds to settle COVID claims. At one stage they were saying, oh, why don't we dip into that nice big pot that we put away for terrorism? But I think it was ultimately resisted to leave the pot there just in case. Next one we handled is constructional plant and equipment. This is obviously anything that's being used in the building of a contract, tower cranes, JCBs and the like, whilst they're in use on a contract site. We can look to cover them within a project insurance, but also we cover these things on an annualised basis for their owners as well. Employer's liability, next one down that list. This is actually the first one of these that's actually statutory. Have to have it by law. The contract works is by choice and by contract. Similarly, third-party liability, other than when it's your own responsibility to have the cover when you're driving a motor vehicle, it's actually a choice cover to have in the building of a building. But obviously employer's liability is covering that legal liability for death of or injury or illness to employees. This is something that's obviously has to be bought by every employer in the UK to cover them in respect of their any sort of thing they might do that causes injury or illness to their staff. Professional indemnity, this is a breach of professional duty cover, where sort of a professional architect or design and build contractor might be exposed to a negligence or a loss from a negligent act that they carry out in their professional business. I'll talk a little bit about that later, but that's what that one's for. Latent defects, another one we get involved in quite a lot. Best known, I suppose, to sort of the general public as the NHBC style warranty on housing. Well, this is latent defects is actually a similar product but aimed at buildings or new buildings particularly. It's a 10 or 12 year protection that the coverage starts on completion of the building, and it's there to protect in respect of any sort of threat of collapse caused by a defect that was constructed into the building at the time of construction. Other aspects we get involved in are the likes of right to light, environmental impairment insurance, personal accident and travel, and indeed archaeological finds. I'm not going to go into too much detail about them. They're sort of what I would call sort of peripheral covers, but they're all important in their own right. We go to the next slide, please. Now, when I entered the insurance market as a fresh-faced 17-year-old, and I was told that the insurance market revolved in cycles with peaks and troughs, and the market would go from being competitive to becoming quite expensive over a flowing 7-year period. That, to be honest, turned out to be total rubbish, as whilst there was a sort of short, hard market period in the 80s and early 90s, with just a small blip in terms around just after 9/11, it's actually been getting softer and softer for over 25 years until quite recently. Right, I've just had a question. I'm just drop back to that. Do latent defects cover the current situation with respect to cladding post Grenfell? In essence, it doesn't guarantee the building. It still relies on a loss or damage event. It could potentially threat of collapse, but actually the cladding issue with Grenfell and similar was not around a threat of collapse. It was a threat of failure in the event of fire. So no, I don't think you would be able to claim for recladding a building in a Grenfell type situation. So sorry to interrupt myself, but that was good. Thank you very much for the person who asked that question. As I said, in 2018, there were a number of significant events in the insurance market. There were 3 quite well-known fires on buildings undergoing construction, with the Oriental Hotel in London, Primark in Belfast, and the Glasgow School of Art being sort of 3 very significant events. And on top of that, we were in a phase where water damage losses from internal leaks, particularly in nearly completed buildings or refurbishment projects, had caused several claims, all of which were in excess of £10 million. I mean, that's a vast sum of money for what could have been just a pipe popping from its splitting and popping away from each other where a bad fitting had been made. You think such a small event causing such a massive loss, and insurers were paying for that, and this is what's part of what's done led to the construction insurance market losing money hand over fist. And as I say, towards the end of 2018, some companies decided that it was so bad that they couldn't underwrite their way out of it, and they withdrew their capacity. The remaining carriers that stayed behind then realised that this was their opportunity to put things right. And whilst we await for the additional capacity to return to replace those departed markets, the market will continue to harden. 2019 and 2020 have seen rates probably more than double. Excesses have increased, particularly in respect of water damage, where insurers have been asking for six-figure sums to be retained by the buyer of the policy to make sure that they're as focused as insurers are on this particular exposure. And we've seen some of the extremely broad covers that we've managed to negotiate into those softer market wordings being reduced, although much of that's really only removing the nice to haves rather than anything fundamental as to how the insurance program might respond to a loss. Just picking up another couple of things from this slide, I suppose. We see sometimes the maximum period that insurers are looking to offer their cover for. Several of them are saying we won't offer it on projects more than 5 years long. That includes the defects liability period. And many are saying actually when they issue quotations, they'll only leave them open to be taken up for a period of 30 days, whereas that used to be almost unlimited or certainly 90 days. There is still significant capacity in the market, although a lack of appetite means that the job is much harder than it used to be. Go to the next slide, please. As I said earlier, PI isn't my area of expertise, but that market itself went hard in 2017, again due to very significant losses in the preceding years, some in Australia, some around the UK. Grenfell itself, as mentioned a few minutes ago, that rests largely in the professional indemnity world as potential reserved claims. It also in 2017, Lloyd's announced that this was the second worst performing class of insurance, and that was underwritten within Lloyd's, and they really said they felt that they needed to get these classes under control. So they were quite limiting in what insurers could do for the future in their underwriting. So terms jumped by probably 100% almost overnight, sometimes more. And they continue to climb to this day, although a recent renewal of mine, where my colleagues in Finex were handling that renewal, it was just a double-digit increase. I think it was probably about 15–20%. Which is obviously a significant improvement, but clients have been seeing these professional indemnity numbers jumping exponentially almost over the last 2 or 3 years. Not only did the prices increase, but even the design of the programs had to change, with insurers removing the each and every loss limits that had been in existence previously in favour of aggregate limits, where rather than having a rotational where a loss can occur from ground up every time it happens, this is more of a rotational payment, whereby you start at £1, and if you've got £10 million worth of cover and you have 10 losses, you're actually eroding that as you go through it. They will allow reinstatements of those limits, although they're paying, clients are having to pay through the nose on occasion to be able to reinstate those limits. Tricky one here, and Bev may cover this a little bit, but one of the tricky things around those changes and PI in general is the client's requirements to satisfy historic contractual commitments. Again, Grenfell, whilst there are no claims settled on Grenfell yet, there are plenty of claims out there with reserves and plenty of money having been spent on properties being brought up to spec that weren't Grenfell. Clients have had to complete a new questionnaire to explain if they've got any historic involvement with any cladding projects, and insurers take a dim view of any where they haven't resolved them from being in a dangerous state. Basically, all of this means that my colleagues in our PI team need more and more time to complete with their renewals, and with the gathering of information taking longer, and each client's relationship with his leading insurer is now even more important than ever. Next slide, please. So the last thing I want to cover before passing over to Bev is to talk about what we do to ensure that our client's renewal or project receives the best response. And again, this all boils down to time and information. Lots of both is our ideal scenario. Insurance used to be one of those things that was left until the last minute to sort out. And as brokers, we became quite proficient at turning things around in a very short time. I can recall many times where we've placed very significant project programs in a matter of a few days or a week. Is very, very different now. I'd say, I would like to say on a decent sized 100 million project or whatever, £50 million project, I'd need at least 3, maybe 4 weeks from the moment I found out about it, with the level of information that we could use to go to the market, that I would need that sort of amount of time, almost a month on each occasion, to be able to develop the terms on that. The level of information has to be good, and the story has to be clear, especially in the area of key interest to insurers: fire, water damage and the like. And even with good information, we're still seeing heat conditions being imposed on policies, along with increased excesses for water damage. And so the level of deductible that's coming in on the water damage losses is, well, it can be along the lines of several, well, £100,000, £150,000 I've seen in the past. And it does definitely seem to focus people's minds. The market also requires more in that information on water damage, something called a water management plan that handles or details how the escape of water might be being handled in the latter stages of a project, whether there are shut-off valves, how each joint is being checked, and sort of how many security guards are walking the site at any one time, particularly overnight and at the weekends. Anyway, I couldn't complete the talk without a quick mention of COVID and COVID exclusions. Our market has settled on something that my wordings specialist described as the least worst exclusion. But suffice to say, the insurance market is not looking to put its hand in its pocket for COVID or other communicable disease style claims in the near future. We'll probably need to have another pretty soft market for that to come about. Back to the issue of time, we're now looking to start conversations with our clients 4 or 5 months prior to a renewal, whereas historically this might have been 3 months. On projects, we're keen to make sure that clients understand that it certainly take several weeks, if not a month or two, to be able to respond with best terms. And once received, they will then themselves be put under some pressure to make a decision, because the quotes will only be held open for a certain amount of time by insurers, with the fact that if you have to go back after that term has expired, the insurers may put the prices up. So a matter of a few weeks to make that decision, and a failure to make that decision could lead to additional cost. I suppose lastly, communication, still a very key thing. It's a key skill we have. Using that to manage the expectation of our clients and the prospects is an absolute key, and using it to obtain the best terms from insurers is why we do the job we do. I'll pass over to Bev to talk you through contractual side, and go to the next slide, please, Sarah.
Thanks, Steve. Yeah, I just wanted to sort of touch on this area because, as Steve has alluded to, made a couple of comments. It is important to understand when you are going into any, you have any contract works requirement, what those insurance requirements should be, and which party you as the authority party or the authority party stroke employer or the contractor should be taking those insurances out. There's obviously a variety of ways that you can ensure your contract works, whether that's owner controlled insurance program, a contractor controlled insurance program, or a mixture of the two with both parties taking out different types of cover. So what you need to really sort of think about is what insurances are needed for your particular project, and consider the contract activity and risk profile. As we've just been talking about for the last few minutes, the market is hardening. So in terms of the insurances you're looking for, you need to consider whether they're actually viable in the current insurance market. So where, for example, you may have asked for professional indemnity cover on an any one claim, the number of claims being unlimited basis, that is becoming difficult, if not impossible, to now achieve. So if you ask for that, your contractor's just not going to be able to comply with it. I mean, the reason for agreeing the insurances up front is obviously to make sure that there are funds available that mean that the works can continue, can be reinstated, and we don't get you don't get more delays than necessary in the event of something going wrong. So what I don't really sort of need to Steve's gone over quite a lot of detail in terms of what insurances can cover. So those are the main ones there: death, bodily injury, damage to the works, damage to third-party property, and then financial pecuniary loss. Could I have the next slide, please, Sarah? Okay. What we have seen from our experience is that insurance and contracts can be quite low on the list of priorities, are not really thought about early in the process, can quite often be copied over from the previous contract that you might have been involved in, and therefore have not taken into account the detail of your particular requirement for this particular project. There are obviously there are forms of contract out there which are quite generic. There's obviously the NEC and JCT, and people quite often just sign up to those, again, without really thinking, does that fit with my requirement, how I actually buy insurance? So, I mean, an issue for authority parties in particular in the public sector is that not all of you buy insurance. So to sign up to a standard JCT or NEC which says you as the employer will take out joint names cover with the contractor makes that quite difficult for you because you don't buy insurance generally. So you do need to, as I said, even with generic forms of contract, you need to look at those and decide whether it's something, if there's obligations on you as the employer, can you actually comply with those? So can I have the next slide, please, Sarah? So examples of issues that we have come across. Obligations on the authority in relation to procurement of insurances. I've just mentioned that one, the joint names cover when you don't actually buy insurance. That can be a particular problem for the existing structures if you're a public sector organisation that self-indemnifies your existing structures. So those potentially could need amendments to the standard contracts. Now that might just be a simple case of the contractor retain. We do also find that when you go back to the contractor starts saying, I can't insure your existing structures. Well, we're not asking you to insure the existing structures. All we're asking is that you retain responsibility for any damage that you may cause to those existing structures. So they can cover that by way of their public liability insurance. Generally within these standard contracts, if it's a new build project, then quite often the obligations are on the contractor anyway to insure the works. In terms of public liability insurance, if you're not doing an owner-controlled insurance program, which is covering the public liability of all the parties, then you are going to want the contractor to take out third-party liability insurance to cover death, injury, and damage to third-party property. As Steve has gone through in a little bit more detail, the issue for you there in relation to public liability cover is what is your requirement going to be in relation to the limits of indemnity. Again, there's always going to be a balance here. You could go in at a very, very high limit, and the question then is that cover still available at the high limit? But also it's the cost of that cover. if you start asking your contractors for very, very high limits, then they're just going to pass that cost back to you within the contract price. If you set the level too low, you could find yourself in a situation when there's a large third-party loss, which the contractor can't meet, and his only option is to go bust, and that third-party claim isn't paid. So as I said, it is a balance when you are considering that. And I think the other issue that we do come across quite often is people actually quote to me, this is the standard limit for this type of cover. There is no standard limit. There is no standard insurance policy. What you need to do, you could have a very small contract with a contractor, which actually, if you look at it and think about what that contractor could potentially do in terms of damaging third-party property, or worse, death and injury to third parties, that actually can be quite high, even though, as I said, the piece of work you're asking them to do is quite small. Professional indemnity insurance, same thing. As Steve has said, professional indemnity insurance is becoming much more difficult for contractors to procure. So again, limits that you may have got on previous contracts, you may have been asking for 20 million PI. That might not be so easy to achieve now, and there will be restrictions on that cover. Insurance is required by law. There are only two, as Steve has mentioned, those being employer's liability and motor third-party liability. I mean, our only interest there really as the employing party is that they're compliant with the laws. So you don't really need to get too hung up, really, particularly in relation to the employer's liability in terms of what limit they may have or may not have. As long as they're compliant with the law, which is 5 million, generally insurers offer cover starting at 10 million. So as long as they've got an insurance policy, they are meeting their requirements by law. What you also want to think about if the contractor is taking out the insurances is what rights you may want in that policy. So what is your insurable interest? So particularly in relation to the works, do you want to be a co-insured party, a joint insured? Do you just, in terms of the liability, do you need an indemnity to principals clause? So on a sort of 1 hour webinar, we haven't got too much time to go through the detail of all of that, but just to cover off a couple of those, co-insured versus joint insured. Co-insured applies when your interests are different and you basically stand and fall together. Your interests are separate. Joint insured is when your interests are the same, and if one insured party, for example, breaches the policy condition, then that means the policy is breached for all insured parties, whereas with the co-insured you can get non-vitiation, waiver of subrogation. So if one insured party vitiates, breaks a policy condition, then that doesn't affect the other insured party being able to make a claim. Indemnity to principals, that's generally available on liability policies within the UK insurance market. And what that means is if somebody brings a claim against you, which has actually been caused by, in this case, the contractor, you can go to the contractor's insurers and say, I want you to indemnify me to the extent that the contractor is legally, he's the one that's actually legally liable to pay that claim. As I mentioned sort of earlier in this slide, setting appropriate insurance levels and basis of settlement is very, very important and will vary from project to project. And as I said, it is that consideration of what can the contractor actually do, but to balance that with something reasonable and that is available in the insurance market, which isn't going to bust the contractor's insurance bill. Just want to mention a couple of other things as well. Claims made versus claims occurring. So what we would generally find in the UK insurance market is that a public liability policy would be on a claims made basis. So as long as the claim is made during the policy period, even if that claim is made 3-4 years after the project has been completed, then the policy that was in place when the incident that gave rise to the claim occurred is the one that will respond. Claims occurring, I've actually said that the wrong way around, and Steve didn't pick me up on that. So claims made, the policy has to be made during the policy period. claims occurring, the claim has to occur during the policy period, but can be made later on. So a public liability policy would be on a claims occurring basis. So it's important for you to make sure that the contractor has got public liability policy for the duration of the works and any defects liability period thereafter. Professional indemnity policies can be on a claims made and tend to be on a claims made basis, particularly with the hardening market. So the policy needs to be made during the policy period. Now, why that's important, and that's why you will see in contracts that, particularly in relation to professional indemnity insurance, there will be a requirement that the contractor has professional indemnity insurance in place, not only for the duration of the contract, but then for a period thereafter. So if a claim comes out of the woodwork after the works have been completed, the contractor has been buying run-off professional indemnity insurance cover that can pick up that claim. In terms of the policy limits, we've already touched on this really, and that again is more in relation to the professional indemnity side of things. So where you used to be able to get any one claim, number of claims being unlimited, it is now being, particularly in the construction sector, contractors are finding that their limits will apply any one claim and in the annual aggregate, or yes, or in the annual aggregate. So what you do need to consider is, when you are thinking about the limits that you might require, that they may well have, not may well have, they are quite likely to have an aggregate limit. We generally find that public liability is still available on any one claim, number of claims being unlimited, with aggregate limits applying to specific limbs of cover, things like sudden accidental pollution, asbestos, for example. Sarah, can I have the next slide, please? So what we would always suggest is that you review quite early on the insurability of what the risks are for your particular contract and how those might be allocated between the parties. Who are you going to expect to take out those insurances? Is it going to be you? Is it going to be the contractor? You then need to look at how you're going to articulate that within the contract. And if you are using standard JCT or NEC 4, 3 or 4, do those need to be amended in any way to reflect how you actually need to cover the risks? You do need, obviously, early engagement between the parties. And what we would say is deal with it very, very early in the procurement process. Because if you try to change this later on, once you've selected your contractor, for example, to try and change the terms then of what insurances you might be seeking, you will get a lot of sucking of teeth and yeah, we can do that, but it's going to cost you extra. It's much, much easier to deal with it, as I said, when you're actually involved in the tender process. So I think that was a very, very quick run through of just areas to be wary of in relation to your contracts. I just sort of want to pick up on one of the points that Steve made about the time it takes now to place insurances. So, for example, if you have accepted within the contract that you as the party will be taking out the cover for the works, for example, you can't go to your broker on a Friday saying my contractor's on site on a Monday, I need this cover in place. It's going to be impossible to do. So it's another reason for understanding what the contractual requirements are, that if you have any obligations on you, that you give your insurance broker, your insurer, time to get that cover in place so that you're actually compliant with the contract. And I think that is it from me.
Thanks, Bev. I was on mute, which is why I didn't jump in on you.
To correct me. Yeah, there are a couple of...
Yeah, I was going to say, we've got a couple of questions. The first one is someone who actually hasn't listened when I said I'm not a PI expert, but I'll read the question and I'll give you my opinion. If I have a specialist rock drilling and blasting contractor for rock excavation who has to design a blasting strategy, would you consider this element of design to be covered by professional indemnity insurance? I've I don't get involved in that particular sector. I haven't had a rock drilling or blasting contractor of my own, so I am really sort of struggling with this. I think ultimately I would say ask a professional, a professional indemnity broker that does it all the time. If you would like, I will put that question to one of my colleagues. So drop me another note. You've got my contact details in the earlier part of the presentation. The second question, with reference to increased excesses, do clients need to consider the risks associated with contractors taking out insurance with high excesses that they can't afford to pay? Again, really good question. This one, you can handle that sort of level of deductible through the bonding process, as in if you're insisting upon a bond, that you've got to sort of work on the basis that that will apply in this respect as well. But I think you're basically looking at the financial stability of your contractor when you're appointing him, as to what should be affordable. I've worked with some major contractors, and they might have an each and every loss deductible of 50 or even £100,000. That's not unusual for a major high street name contractor, because they don't want to pound swap with insurers, and literally it just seems to cost money to pound swap with insurers. So they're always going to take that route to the best insurance program for them, and for them managing those claims costs actually isn't normally too difficult. There'll be a head office pot to do it. I think if you see a small contractor taking a very significant deductible, particularly one that isn't associated with, like, say, for example, water damage or the design defects deductibles that we see in the market, then yeah, be a bit wary of those. To clarify that point, design covers, I mentioned they're an exclusion within a contract works policy, but they're an exclusion with a buyback. And the broadest form of cover comes with a very good buyback, but it also comes with a very significant deductible. Basically, the standard market deductible for that sort of London Engineering Group 3 or design exclusion number 5 tends to run to £150,000 for each and every loss. That's partly because it's almost intrinsically linked with professional indemnity and the sort of claims that you can get through that. And as I mentioned earlier on, the water damage deductibles can often be into 6 figures. Got a couple more questions arriving. Without being too cynical, is the PI market difficult to obtain cover, particularly for fire, or is it just more expensive? I think that one actually it is becoming far more difficult, particularly for someone who's got a cladding exposure, to obtain cover for that exposure. Yes, it's becoming more expensive, and that I sort of covered that off in my earlier slides. But I do accept some clients, some contractors, designers, architects are struggling to sort of get the cover that they might have had in the past, not just by way of the limit, but there are exclusions associated with this sort of cover. I'm going to let Bev, do you want to do the one about JCT framework?
So the question is, we have a JCT framework contract and want to allow other authorities to use it where the contractors will be working in properties we as an authority don't own or insure. What insurance provisions do we use? Our own buildings are insured, but not via joint names policy. None of the JCT clauses seem to fit this scenario.
That's kind of I was going to say that's the option C within JCT under the contract works, and it's in the 2016 JCT. Funnily enough, paragraph C1 can be deleted because JCT option C anticipates that the owner of an existing building is also the person who's having the work done, and therefore he is in control of having sort of insuring the works, but also insuring the existing structures. In this circumstance, where he's not not in one or other of those roles, then he can't, or the contractors can't be given that sort of joint names protection for the existing structures at least. So paragraph C1 being deleted then basically makes that existing structures into third-party property. for the contractor. And then you're relying on that contractor to have sufficient limit of third-party liability cover to protect in respect of any damage you might do to the building. We see this quite a lot on major London fitting out projects where, I mean, in the walkie-talkie is a really good example. It's a £500 million building, for want of a better number. And if a contractor is going in to fit out one floor of that, does the entire £500 million building fall to become third-party property? Often that can be the case, but we normally manage to obtain a sort of a limited approach to that, whereby the contractor has to evidence, say, £50 million worth of cover, and that's seen to be sufficient, and then it gets access to the existing structures insurance above that number. I hope that's covered that question.
We've also had a question raised in the chat. Can you see that one?
I was trying to do the ones from the chat, to be honest. Have I missed one?
I'd be interested to know if you're seeing changes to material damage and business interruption cover, where there is a removal of cover for infections, notifiable communicable diseases. Just by way of background, this is at this stage impacting us on a PFI project built and operational for many years, where the SPV are responsible for providing the project insurance, and we have been notified that they are unable to obtain the cover that the project agreement sets out. In simple terms, the COVID exclusions, as Steve alluded to in relation to the contractors' insurances, are applying to the material damage and business interruption insurances as well. So the simple answer is yes, they are becoming more difficult to obtain as they come up for renewal.
That's, to be honest, probably somewhere between more difficult and impossible.
Yes.
Right, I can't see any more questions.
No, I can't. And what I'll do, Steve, is the one that we couldn't answer, I'll send it over to you later, and then we'll get back to the customer after you've done some asking around. So just be aware that we will come back to you.
Damn it, I thought I'd escaped.
Unfortunately not. But if nobody else has got any more questions, you can always get in contact with me anytime on my email address is insurance@ypo.co.uk. Just drop us an email, and if we can't answer it, I'll get in contact with Bev and Steve and come back to you. So if we've got no more questions or anything, I'd like to say a big thank you to Bev and Steve for doing this webinar. We really, really do appreciate your support. Without you, we couldn't actually get these special webinars delivered. And I'd like to thank everybody for attending. In a minute, another question has just come in, I think.
Oh, no, it was a thank you.
Yeah, thank you very much. Yeah, so what I will do is I will share these slides. I will share the recording within the next day or two. Again, big thank you to Bev and Steve. Thank you to everybody that's joined us today. Have a good day, and we'll see you soon. Take care.
Thank you.
Thank you. Pleasure.